Thinking of becoming a landlord in 2025? With rising mortgage costs and changing rental demand, not every area in the UK is profitable anymore, but a few regions are still offering strong rental yields. Today we'll break down the top buy-to-let hotspots across the UK and reveal which types of property deliver the best returns. The average UK house price sits just under £300,000. Growth has slowed to nearly flat, yet rents keep climbing. That means your return now depends more on where you invest, not just what you buy. Rental yield is simple. It's your annual rental income divided by your property's value. For example, £10,000 rent on a £100,000 property equals a 10% yield. But remember, that's before costs like mortgage interest, maintenance, and vacant months. Let's get into the rankings. Number 1, Wales. Average yield around 8.8%, thanks to relatively low house prices and solid tenant demand. Number 2, North East, about 8.1%, driven by affordable property values and steady rental income. Number 3, South West and Northwest, both sitting near 7.8%, offering balance between yield and long-term capital growth. Number 4, Yorkshire and the Humber, roughly 7.8%, still attractive for investors, targeting family homes and student lets. Meanwhile, Greater London trails behind at around 5.6%, weighed down by high prices and tighter margins. Wales has become a landlord favourite because entry prices are low, roughly £70,000 below the UK average, but rents have kept pace. That combination boosts yield potential without needing massive upfront capital. The North East continues to perform well with consistent demand from local workers and students. The North West and South West offer more stability, slightly lower yields, but stronger long-term growth potential. Yorkshire and the Humber remains a solid all-rounder with balanced affordability. London might look lucrative on paper, sky-high rents and demand, but yields rarely top 6%. Property prices are just too high for the numbers to stack up. Many investors now look north or west for better cash flow. Now, let's look at property types. The best performer remains HMOs, houses in multiple occupation, averaging yields above 8%. That's because you rent by the room, creating multiple income streams. Next are freehold blocks, buildings split into flats, with yields just above 7%. Standard flats and terraced houses hover around 6.2%, offering simpler management. Detached homes and bungalows are the weakest, with yields near 5%, mainly due to higher prices and lower rental density. High yield doesn't mean easy money. HMOs require more management, licenses, and maintenance. Multi-let properties face higher wear and tear and more voids. Even single lets come with mortgage, letting fees, insurance, and compliance costs. The real figure that matters is your net yield after everything. Start with yield data, but don't stop there. Check demand. Who's renting? What's the local job market like? Are universities nearby? Visit the area, talk to agents, and stress test your numbers. A solid buy-to-let works on conservative assumptions, not perfect conditions. To recap, Wales currently leads UK rental yields, followed by the North East, South West, North West, and Yorkshire and Humber. HMOs and multi-unit blocks give the highest returns, but they demand more effort. London offers security, but at much lower margins. The best investment is the one that fits your risk tolerance and management style. If you found this breakdown useful, hit like, subscribe, and tell us in the comments. Which region do you think is the best buy-to-let bet for 2025? More UK property insights coming soon.